It's all too easy to blame one man, Asil Nadir. He was sentenced last week for crimes including theft in relation to what was once his glorious PLC company listed in London, Polly Peck. In this video, what I want to show you is that actually investors who say it was all his fault, the reason I lost money when Polly Peck disappeared, and it disappeared quite a long time ago now, after which he fled to Cyprus to avoid being prosecuted here. It's not good for investors saying, well, the reason I lost money was him. Because actually, Polly Peck was up to something that other companies can still use today, and investors need to be alert to. So this video will disappoint some people. It's not a history of the Polly Peck collapse. I'm not going to stick to the exact facts either, because what's done is done. The past is the past. As an investor, you want to know, well, what do I take away from that to use now? And that's what I want to get to, because there was a little accounting trick used by Polly Peck that boosted profits before it went bust at the expense of its balance sheet. Okay, and any investor could have spotted that happening. And if you're investing today, keep an eye out for it. So what was the trick? Was the collapse of Polly Peck all down to one clearly slightly dodgy man who's now going to spend some time in prison? No, actually. That was part of the problem, but too many people have jumped on the bandwagon and said, well, thanks to him, I lost loads of money. And actually, they could have done a little more homework themselves to realise that all was not well and bailed out before the firm actually finally collapsed, buried under a mound of losses. Okay, so here we go, a little bit fast and loose with the facts. I'm going to keep the numbers nice and simple because I want anyone who's never seen this before to walk away with a rough understanding of what the problem is and how you could be fooled as an investor if another company was pulling the same trick. So here's the story. All right. Now, imagine you've got a UK. That's the UK. People who've seen my videos before will know that graphics are not my strong point. Okay. Ireland. Now it's clear. All right. So here's the UK. And you have a listed PLC public company in the UK. All right. And the next player in the story I want to introduce is what's called an overseas subsidiary. Very grand sounding title. I'm afraid I'm slipping into accounting speak here, but don't worry, that just means a big company overseas, okay, and we'll put that company in Cyprus. Now, that company is owned by the listed PLC in the UK. It's part of the same group, okay? So how's it financed? How does it do anything as a separate operating company? Well, the answer is there's a loan in sterling, okay? And we'll call it, well, I'm going to use very simple numbers here. Let's call it, obviously far too small, £10,000. Right, now you might say 10 million or 100 million is more likely, but I'll keep the numbers simple because it's the principle I want to get across here, not the exact forensic facts. All right. So the overseas company in Cyprus is funded with a loan from its UK parent company, £10,000. So it's borrowed from its parent company. To do what? To invest in a Turkish business operation. Okay, so you have an overseas subsidiary based in Cyprus, you have an operation in Turkey, orange groves and the like, okay, and you have the Polly Peck listed UK PLC at the front end, all right? And how is that Turkish operation funded? Well, having taken a loan of £10,000 from its parent company, let's say the exchange rate, to make it very, very simple, is 1 for 1. Now, I know that's a little unlikely, sterling to Turkish lira, okay? Let's say exchange rate 1 for 1, so the £10,000 has been taken by this subsidiary company, switched into Turkish lira, which is 10,000 Turkish lira, and that's been invested in high yield Turkish operations, risky Turkish operations, okay? Because here's the point, sterling is a strong currency. Let's say for purposes of illustration, the Turkish lira is a much weaker currency, so the returns you expect to earn over here are much higher than what you expect to have to pay in interest here. And here's the trick, okay? So you take your £10,000 loan, you switch it at an exchange rate, artificial I know, of 1 to 1, and you invest your 10,000 Turkish lira over here. Now, let's, again, for the purpose of illustration, keep the numbers very simple. Let's say the interest rate on this loan is 5%. And the return you expect to earn over here in the much weaker currency, okay, is more like 20%. Now, here's the trick. Here's the trick coming up. So what you've done, very simply, is borrow in a strong currency, invest in a much weaker currency. Weaker currencies generally offer a much higher rate of return. Why? Because central banks operating in weaker countries have to generally offer higher interest rates, okay, higher rates of return than central banks in much stronger countries. All right, so still true today. The interest rate on things like pounds and dollars much, much lower than it is on, say, emerging market currencies. All right, so far, so what? Well, here's the trick. What you've effectively set up here, in very simple terms, is a tremendously profitable little operation. Because let's take a look at the income statement. All right, let's take a very simple income statement for this little overseas subsidiary company. All right, it's earning 20% on 10,000 lira. Now imagine it's got to report back to its parent on how it's doing. Okay, it's got to report back to Polly Peck. Polly Peck, after all, has funded it with this 5% loan on how it's doing. So what it does, it says, well, we're doing all right actually, because we're earning 20% on our 10,000 lira. Okay, that's 2,000 lira, and at a 1-for-1 exchange rate, that's £2,000 in sterling to report back to the parent company. So the income's looking good, £2,000. And our costs, if you like, just looking at two lines of the profit and loss account, our costs to generate £2,000 sterling, that's 20% of 10,000 lira at an exchange rate of 1-to-1, is the 5% loan. All right, so it's costing us 5% of £10,000, right, or let's say £500 annually. So we're making a nice profit, making up the numbers here, of 1,500. All right, very, very simply, we're earning a much higher return in Turkish lira at this current exchange rate. Artificially, I've made it 1-to-1, than we're paying on our loan. So whoever's running this gig can report back to whoever their boss is in the UK and say, well, it's going rather well, actually. I'm making a £1,500 profit. Okay. Now, here's the reality, of course, of weak currencies. There's a clue in the term, they get weaker. So the exchange rate may have started out at 1-for-1, which makes this, in sterling, look like a pretty good operation. But let's assume the Turkish lira does what weak currencies tend to do in relation to strong ones, it weakens. Right? So let's assume that after a little while, let's say a couple of years later, the exchange rate has moved like that. It's moved dramatically. So now there are 2 Turkish lira for every pound, because that happens. Weak currencies weaken. Right? How does the income statement now look for our overseas subsidiary when the boss rings up and says, how are you getting on out there? Okay, that's the UK boss. Well, let's take a look at it. We're still earning, let's assume, 20% on an original investment of 10,000 lira. All right, so that's £2,000, but unfortunately the exchange rate has moved against us. So in sterling, that is only worth half what it was. But it's still all right because, you know, half of £2,000 in sterling, because of the exchange rate movement, is still £1,000 in sterling. So although the exchange rate has really changed, the lira has weakened, there are more lira to a pound, our income in sterling is still not bad. Our costs in sterling are still 5% of £10,000. Right? So we can ring up the boss in the UK and say, well, it's not going as well as it was, but overall, in sterling terms, we're still not doing too badly. Okay, not as bad as a few years ago, but we're still making a profit. All right? And that's what was happening at Polly Peck. Every year, even though the currency of the operations of this massively important subsidiary was weakening, it was able to report back to the UK, and the UK was able to subsume its results into its own results reported to shelves in the UK, income, net income. Okay, the difference between its income and its expenses. But some of you will have spotted there must be a catch. Okay, it's otherwise some kind of magic trick. You just get income for investing the same amount in a different currency. Well, the answer is yes, but of course there's a price, and the price is this. Were you, when the exchange rates moved from 1 to 1 to 1 to 2, were you to say, what's our original investment worth now over in Turkey, in sterling? If you did that as a check, you'd say, well, we put £10,000 in, which was switched into lira at a rate of 1 for 1. So unfortunately, here's your problem. What was a £10,000 original investment with an exchange rate of 2 to 1, switch that back into sterling, of course, the original investment is only worth half what it was. So in sterling terms, the original investment is now only worth £5,000 using these very simple numbers. Okay? So there's a capital loss somewhere out there of a rather hefty £5,000, right? So the income statement may still look fine, all right, but things are going a bit pear-shaped in investment terms. Now you might say, well, that's all right, because everyone will realise that it'll be reported in the UK accounts and people will go, aha, I see how you're generating income. It's at the expense of annihilating your investment in sterling terms in a weaker currency. But no, you see, because the accounting rules, the way, without going into details, this is not an accounting degree, but the way you bring this operation into the UK accounts means that all of this loss goes through the balance sheet of the listed PLC in the UK. Okay, it's there, but it goes through the balance sheet. So what you've got is this rather clever trick. You've got a profit and loss account, an income statement, generated here, being subsumed here, that shows shareholders here, a pretty picture, and it could go on for a number of years, even as the currency over here weakens. But anyone who read the balance sheet, I stress anyone who read the balance sheet, and very few people do, would have seen the balance sheet being crushed and crushed and crushed and crushed over the same time period. So you had great income statement, great profits, and a shrinking balance sheet. Plenty of people looked at the former and went, brilliant, great job, Asil, and didn't look at the latter, where they'd have realised there was a problem. So after all of that jiggery-pokery and my slightly artificial numbers, the takeaway is simply this for investors today. You cannot just look at a profit and loss account and go, great, profits coming through, I don't need to worry. Fantastic company, charismatic CEO, what's not to like? Okay, as Sir David Tweedy, knighted for his contribution to accountancy, and that's not easy to do, okay, once head of the International Accounting Standards Board said, the most important financial statement you'll ever look at is actually a balance sheet, because only there could you have seen what was happening to Polly Peck in reality. And you could have seen it a few years before it went bust, what's more. So, investors who blame Asil Nadir, that's fine, he was a naughty man, he's done some things which were not good, but was he the sole reason people lost money on Polly Peck? I'd say no, he wasn't. Takeaway from this video is if you've never seen a balance sheet before and you plan to be any kind of semi-serious investor, please at least get to grips with the basics of it. And as luck would have it, I have a video out already called What is a Balance Sheet? And for anyone who's thinking I didn't really understand a word of that, but Tim seems to be getting quite excited about it, I'd urge you to go and have a look at that video right now. To download this free video to your favourite mobile device, find us on iTunes by searching for MoneyWeek. And the entire video archive is also available free, just visit moneyweek.com.